If you're judging your law firm's health entirely on gross billable hours, you're flying blind. Welcome to The Explainer. Today, we're urgently challenging the status quo. For far too long, this industry has completely worshipped the billable hour and top-line revenue. And honestly, it's a trap.
Because here's the reality. Gross revenue can easily hide massive, leaking margins. To find your true client net income, you have to dig past those top-line numbers. Think about it. You could easily have a high-volume client generating massive gross fees, right? But what if they're actually costing you money every single time you pick up the phone because of how inefficiently that work is staffed? It happens all the time.
Now, standard accounting views, like your traditional P&L statements, they're incredibly opaque. They're basically flawed when it comes to making real strategic decisions because they just lump everything together. But a true client net income engine, that's an interconnected, data-driven matrix. It fundamentally shifts your focus from just asking how much money came in to exactly which clients, matters, and timekeepers are actually generating profit.
So what does a firm actually need to pull to fix this? Well, you need 5 core metrics directly from your time and billing system. Ready? You need fees billed by the working attorney, hours billed by the working attorney, origination credits, AR write-offs, and total fees received for timekeeper. That's it.
There's absolutely no guesswork here, just clean math. Pulling these core metrics down to the client or matter level is the absolute first step to fixing your firm's profitability. Look, you literally cannot optimize what you can't measure. If your time and billing system isn't easily spitting out these 5 specific data points, that is bottleneck number 1 that you need to address.
Once you have those numbers, you map them against your payroll, and boom, the real profit trends finally appear. Because revenue isn't just floating in a vacuum, right? It's tethered to the actual cost of producing it. We take the timekeeper's specific payroll cost per hour, and we combine it with their precise share of the firm's overhead.
Now, when you run this analysis, you'll generally find that about 70 to 75% of your costs are direct costs, meaning things directly tied to producing the legal work. The remaining 25 to 30%, those are indirect costs. And here's the kicker. Applying a flat generic overhead rate across every single lawyer in the firm, regardless of their role, distorts your actual profitability completely. You just can't do it.
Let's look at the key cost drivers that fuel this engine. We're talking timekeeper salaries and benefits, secretarial support, business development, and facilities. And a really important note here, as per-seat software licensing and cloud computing become the standard, IT costs are increasingly shifting from general indirect overhead to very specific direct per-seat costs. Those absolutely need to be allocated accurately to the timekeepers using them.
Here's a crucial strategic point from our source material. Do not punish your staffing mix with bad math. You must allow younger lawyers time to build value, resulting in higher build rates. If you apply full partner-level overhead to a junior associate, your partners are going to be terrified to use them. Why? Because the associate will look artificially unprofitable on paper. You have to remove that disincentive.
In practice, this clean math completely changes the compensation conversation. When you pull a client net income report sorted by the originating attorney, you get the real story. It shows exactly how much actual profit an originating partner brought in, but only after all their specific costs and their team's costs are fully accounted for.
Diving even deeper, calculating the net profit per hour and the percentage profit for individual timekeepers exposes exactly who is absorbing overhead efficiently. You can literally see row by row if a specific attorney working on a matter is generating a 36% profit margin or a 17% margin, even if the top-line billed amount is identical.
This data gives you the exact blueprint to staff smarter. By tracking profitability against a timekeeper's years of experience, firm management sees the efficiency of their mix in real time. Think about it. If a 16-year veteran is doing the bulk of the workload on a routine matter, your profit percentage plummets. Shifting that exact same work to 5- or 6-year associates optimizes your margins immediately.
All right, let's move into interpreting these results and taking strategic action.
Here are the immediate action steps you must take once you have this data. Step 1. Analyze those high-volume, underperforming accounts. Step 2. Adjust your staffing mix efficiency. Seriously, stop putting expensive partners on tasks meant for paralegals. And Step 3. Implement data-backed billing rate increases. With clean math, you can prove exactly why a rate hike is necessary to maintain an acceptable margin. But remember, singular strategies aren't optimal. You can't just pick one. Fixing your firm's health requires a holistic mix: rate adjustments, controlling your overhead structure, and improving realization performance. And by realization, I mean actually collecting the money you bill without taking massive write-offs.
Which brings us perfectly to pricing. The legal industry is moving heavily toward alternative fee arrangements, or AFAs. Pricing a fixed fee without knowing your true costs, that is literally gambling with your firm's money. Whether you use a blended rate, fixed point pricing, or contribution margin percentages, having true profitability data removes the guesswork entirely.
In a model like PerformLaw's alternative fee model, you can see how knowing the true hourly cost yields exact break-even rates. Knowing the precise costs for partners, associates, and paralegals allows you to model out exactly what a fixed fee or blended rate will yield. You can price at the low end, the median, or the high end with absolutely zero guesswork before you ever sign the engagement letter.
We've covered incredible ground today, moving from vanity metrics to the absolute bedrock of law firm financial health. I highly recommend you download the guide, Client Profitability, Analysis to Action, to see what this reporting looks like in practice. It is the exact roadmap you need to transition your firm away from guesswork.
So, you now know that top-line revenue is a mirage without underlying cost data, and you know the exact 5 metrics required to fix it. The only question left is this: will you continue flying blind, hoping billable hours somehow translate to cash in the bank, or will you build your firm's true net income engine today?